Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The new financial year, FY20, has started off on a rather good note for mutual fund investors like you and me. And this is because a regime that was announced by market regulator SEBI way back in 2018, a regime that would reduce the cost of investing, finally kicks in. What we're talking about is a reduction in the total expense ratio, or TER, that mutual funds can charge their investors to basically manage and run that fund. Now, how significant is this reduction? Which funds get impacted? Is this going to influence your investment decision in any way? Should it influence your investment decision in any way? Those are some of the questions that we are going to take up on today's show. And joining me to do that is Feroze Azeez, Deputy CEO, Wealth Management at Anand Rathi. Feroze, pleasure to have you on the show as always. So it's good tidings for investors, right? As we're starting off the fiscal, the cost of investing is going down. Is that right?
Yes, I think it's a very important news which every mutual fund investor should take note of. So is it a good news? Of course, it's a very, very good news. Second, what is the extent of it, the good news? Of course, it's very significant because there's a reduction of anywhere between 12 to 15% of the cost which you were paying for the active management in the mutual fund, especially the equity side.
Okay, so we understand that now there are very clear defined slabs that SEBI has put out, where at first glance what struck me was that the smaller the size of the fund, the more it can charge its investors. So the first slab, which is an asset, AUM or assets under management of 0 to 500 crores, there the charge can be as much as, I think, 2.25%. Is that right?
Correct. So 2.25% for the first 500, and then you have a reduction slab-wise. Above 50,000, any amount of extra AUM the mutual fund garners, there's no further reduction. Okay. So you at 50,000 come down to as little as 1.25%. Okay. From 2.25 to 1.25 at 50,000.
Okay, first of all, before we understand the slab, just taking a step backwards, what do you think prompted this? I mean, were funds really charging us too much, and can we expect more reduction, or is this a fair regime that's now set in?
So point one, what's triggered this? To my mind, economies of scale. When the industry becomes large enough, the fund management cost is not a variable cost. You have the same fund manager, you have the same analysts, maybe definitely there could be 10-20% more cost. But if your AUM's asset under management in the last 17-18 years, since which it has not been tampered, has gone up almost 30 times, that's serious economies of scale. So this cost reduction is a result of economies of scale. Point one. Point two, I think it has come later in the day than it should have, because a 30 times multiple on the AUM should have already reduced the cost considerably. And the next question which you asked, Surabhi, it's very important. Do you see such further changes? To my mind, next 3-4 years, I don't think they will change it dramatically, and I think this will stay. The last question, is it fair? Is it globally acceptable, these kind of costs? To my mind, yes. Okay. In active management, if you look at the top 5 economies from a mutual fund standpoint, the costs would be just about 5 to 7% more than the aggregate Indian mutual fund industry.
Okay, so we are globally competitive and our scales are matching now what sort of happens in the international fund industry. But that also brings me to the other important debate. Now, I don't know to what extent this kind of had a flow from the fact that passive funds are increasingly becoming a little more, important in India. We've seen them do well. This whole active versus passive debate. So here in this change, there is a reduction for the passive fund charges as well, I believe. Is there?
There is a reduction, but it's very important to note that most fund managers who are doing passive, where there's no cost, you're just replicating the index, where the cost is largely execution cost, the reduction was meaningless because nobody was actually utilizing the entire limit. But in equity funds, especially open-ended, every rupee provisioned was actually being utilized by all funds. So point one, passive vis-a-vis active debate is a very important debate going forward. But in my opinion, next 5 years, active management in India still has merit before our markets become as efficient as they could be, like they are globally. Point two, that reduction is not so meaningful in the passive managed funds because anyway, the fund manager was not utilizing the limit provided.
So, in my understanding, most passive funds were charging somewhere around 40-50 basis points. That was their total expense ratio.
Yes, they were charging 40 to 50 points, 50 basis points, that's a 0.5%. Globally, passive funds have charged negligible, 0.05, which is 1/10 of Indian passive funds. In fact, there are some funds which have now started paying money to investor to invest. Negative TER is also a concept, in the US, latest fund launched with a minus 0.03%
so they pay you extra for investing. Your NAV actually goes up.
Yeah, because of the cost, negative cost. So we are far away from the passive management, but in the active management, we are comparable.
We're pretty comparable. Okay, Feroze, so now that we've understood the overarching thesis and the theme behind this and the way actives and passives are adding up, I'm just going to come down to the cost, just to reiterate in case you've missed this earlier. So funds which have a corpus, or basically assets under management of less than 500 crores, as Feroze pointed out, there the total expense ratio is 2.25%. For 507 to 750 crores, it comes down to 2%. Funds that have assets of 750 crores to 2,000 crores, there's 1.75%. That's the maximum that these funds can charge. Then there is a 2,000 crores to 5,000 crores bucket. And there again, the TER comes down to 1.6%. 5,000 to 10,000 crores, 1.5%. So as we're seeing, as progressively the fund size increases, the amount of money it can charge you and me is going down. And then there is this category which is interesting and help us understand this. 10,000 to 50,000 crores, there is a TER reduction of 0.05% for every 5,000 crores of increase in AUM. Now, I'm trying to understand this because I think a lot of the large cap funds that people like us actually invest in fall in this bucket. So what does it mean for cost for us?
It means that, for example, your total cost of the expense ratio, let's assume, is 1.5% at 10,000 crores.
Right.
At 15,000 crores, it becomes 1.45.
Okay.
At 20,000 crores, another 5 paisa reduction, 1.4.
As the size of the fund increases. Okay.
So in steps, in 8 steps, from 10,000 to 50,000, you have 8 steps of 5,000 crores.
Right.
So there will be a total 40 paisa reduction. 5 into 8. 40 paisa reduction. So after 50,000, it will get capped at 1.1% beyond 50,000.
So this is as a fund grows in size from 10,000 to 50,000 crores. What about funds which are existing within these limits right now? Let's say a fund which is 20,000 crores. Will it have to slash cost immediately? How much will it charge me?
It will charge you, it will slash cost immediately.
Okay.
It will charge you on incremental basis. So the one thing which an investor needs to understand is that the first 500 crores is going to be charged at 2.25.
I see. Okay.
The next 250 crores will be charged at 2%.
All right.
So the mechanism is on incremental basis.
So this is pretty similar to the way we pay income tax. You know, it's as per slab, and you don't get charged flat 30% because the first sort of 5 lakhs is charged at the initial rate.
It is the absolute right comparison. I couldn't come out and articulate it so well as you did. It is like the income tax slab. So till 10,000 you're going to charge 1.5, and then the next 5,000 crores is 1.45. The next one, 5,000 crores is 1.4.
Okay, well, brilliant. Now that we've understood the mechanism of how this works, the question is which are the funds that will be impacted, and should you as an investor do anything about it? Is there any reason to rethink your strategy? We come out with the top 10 funds. This is a list that Feroze has drawn up for us. The top 10 funds that will see the biggest drop in cost of investing because of these new norms. Don't go anywhere. That very interesting analysis is coming up right after this break. Welcome back. You're watching Money, 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 and this week we are rejoicing because the cost of investing in funds, equity mutual funds especially, is going down in FY20 thanks to a reduction in the total expense ratios that mutual funds can charge. Now the question is which are the funds that are likely to see the biggest drop, and whether you should do anything about it, whether it influences your decision to invest. Just to put things in context, Feroze, you were telling me earlier in the break that the total savings that investors stand to gain runs into what? In 2,000 crores, did you say? How is that even possible?
See, what happens is, because the total assets under management is close to 8 to 9 lakh crore in the equity category, the average reductions of all those 400 odd funds which are in this category is 0.2%, 0.21%. 0.21% of 9 lakh crores comes to close to 2,000 crores.
Wow.
So the circular is worth 2,000 crores.
That's a lot of money for sure, and that's big savings for investors out there. So let's straight away get to where these savings are happening. Which are the funds that are seeing the most dramatic drop in cost?
So the funds which are taking the maximum hit on the expense ratio, which is a bad news for the fund manager, naturally. That's why I'm calling it a hit. And the best news for investors in these funds is that the reduction. So HDFC Balanced Advantage Fund, which has the maximum reduction in the entire universe, the reduction is still not reflected because it's been implemented from 1st of April. The March expense ratio was 2.16%, which is what we are in. We've seen the fact sheets of March. April expected expense ratio is 1.79%. So that means a reduction of 0.37%, which is a 17% reduction in cost. 2.16 falls to 1.79. So you're getting it 17% discount on this fund management from the same group of people who are helping you manage this money.
So this is a big reduction. This is the biggest one in the universe. So now the question, is it going to influence your investment decision anyway? Just because this fund is becoming cheaper, should you look at it? Because there's a fundamental analysis to this as well beyond just the cost.
See, Balanced Advantage Fund is a hybrid fund, and in my opinion, after the the tax changes on equity funds, balanced funds, the merit of balanced funds has come down. Like we've seen a fall in the balanced fund AUM. It's a balanced fund category, so it's a sell from my perspective, because you're better off combining a good fund in the same basket, if you like, of the equity side and the debt side. So this will be a sell in spite of the largest fall in the expense.
Okay, so don't get swayed by the fall in expense ratio that's Feroze's take. Let's move to the next one. So the next big fund to see a fall in cost.
So it's SBI Equity Hybrid Fund. This is also a fund which is in the balanced fund category because it's a hybrid category. Here the expense ratio is 1.97, which can come down to 1.69 in the month of April and beyond. That's a reduction of 0.28% of fall, and a percentage discount on fee is 14.45%.
Okay, and your call on the fund?
The call on the fund is again a sell because it's a balanced fund. See, what used to happen is when a lot of distributors and asset management companies were enjoying a larger expense on the balanced fund category, because you also have a debt portion there and an equity portion there. You're paying an expense ratio on the debt side which is far more. Under the garb of paying it for the 65, you're also paying it for the other 35. So the largest drop have come in the balanced fund, and rightly so, because you're not supposed to be paying such expenses to get a debt fund portion managed.
Okay, so irrespective of the drop in cost, balanced funds, and these two are a no-no for Feroze. Let's come down to the third fund, and again this is a hybrid fund, the ICICI Prudential Equity and Debt Fund, and again this is the one that has seen a big drop in cost.
Yes, this fund also has seen a drop in cost of 0.28% and a 15%, 14.5% discount on the cost, and this again turns out to be a balanced fund. The inference to be derived out of the first three funds we've spoken is balanced funds were taking clients for not a ride,
For a ride, yes, that's the easier phrase.
That's a little harsh way to say it, but you're charging more than they deserve to, because
so do you have a sell on balanced funds in general because of this cost factor, that being one aspect which is now coming under curb, or is there another fundamental reason why you generally dislike balanced funds?
See, any product has to be seen on three primary categories, primary verticals. One is return, risk and cost. These are the three. In return, balanced funds don't score so well. If you take an ICICI good flagship equity and manage it using equity and debt of ICICI, it beats the balanced category of ICICI. So apple and apple comparison gives you 2% more by segregating it.
Wow, that's a big difference if you simply segregate it and go with one equity and one debt fund.
Of the same fund house. So I'm not comparing apples and oranges. So that's across a 10 asset management company analysis. So that's one reason. Risk is marginally lower because it has money in debt, but on the cost it was faring low. So out of the three parameters, two were good, two were bad, and one was good. But it was a sell.
All right, so I get your thought process with respect to balanced funds. So the top three funds which have seen a big dramatic fall in costs are actually in the hybrid category, and they happen to be balanced funds. All three are sells for Feroze. Let's move to the fourth one, the KOTAK Standard Multi-Cap Fund. This anyway is a very popular fund. And now you're telling us even better news that it's going to become cheaper in terms of investment?
Yes. So this is where the actual good news exists, because a fund which I don't wish to invest reduces cost is not going to be meaningful for me. So KOTAK Standard Multi-Cap is in the best category. To my mind, multi-cap is the best category. More the freedom to the fund manager, more the active management will be worth paying for. So that's KOTAK Standard Multi-Cap. Category is good. Fund management, Feroze Upadhyay is wonderful. It's a large fund, but still agile enough to move around stocks. So I would say it's a buy, strong buy, and that's reduced cost by 0.27%. That's a 13% discount on the cost so far.
Wonderful. It was charging 2.12%, and now it's expected to charge 1.85%. So this is good news for those who are looking at perhaps multi-cap funds. Let's move to the next one. The HDFC Mid-Cap Opportunities Fund is also a humongous, gigantic fund, right? With some 20,000, 22,000 crores of AUM.
Correct. So this is again a very, very good fund managed by one of the best mid-cap fund managers of the country, which is Chirag Setalwad. And I think it's very well diversified, still has kept the risk under control, and has done a great job. But I would say before the elections, I would stay away from mid-caps currently. That's why a hold strategy. If you're already in the fund, rejoice the expense discount. But I don't think you will have to add too much in this fund currently. Okay,
we're done with the top 5 funds where we've seen a fall in cost thanks to the new norms that have kicked in. Let's move to the 6th one now. And this is the HDFC Hybrid Equity Fund, where the expense ratio has come down from 2.08 to 1.82. But you don't like this fund?
Correct. This is again a balanced fund. It's a hybrid category. You should ideally be taking a low-cost debt strategy rather than a balanced fund, because you can get your debt funds managed at a low cost of 0.6, 0.8% as well. You should never pay almost 2% to get your debt portion managed. So if you segregated equity and debt like we just spoke, your 2% extra return is possible over 10 years. It becomes a very large quantum to let go.
Okay, so that's a separate lesson that we've learned on the show today as well. Let's move to the 7th fund, the HDFC Equity Fund. Again, it's one of the funds which has seen a big fall in cost. What's your view here for this?
It's one of the oldest funds, managed well, I would say, but HDFC Equity is not a contemporary fund.
Okay.
I see what happens is a fund has a lot of legacy stocks which it's holding. I think its concentration across financial services gives me a jitter, especially when the bank nifty is right up there.
But aren't all large cap funds so heavily oriented towards financial services these days?
Yes, because it is the largest representation in the nifty as well. So funds also have it, but the point to be noted is if you're in financial services, you will have to be in the new age businesses in the financial services. It should not be as concentrated as HDFC Equity is. It is following a dual strategy. It's concentrated on a fewer stocks. It also is following a diverse strategy by distributing the rest of the money very thin and has bet big on 3 stocks, which to my mind is a dichotomy inside the same fund. So I've been a sell from May 2015 and I think I continue to say that.
Okay, so that's a no-no. That's 7 funds done. Let's run through the last 3. The ICICI Prudential Blue Chip Fund. This is one of the group's, of course, flagship funds. What is the view here? And we're talking about a reduction from 2.28% to 2.03%, likely reduction on the ICICI Prudential Blue Chip Fund.
Yeah, this fund is a hold. Okay, on a scale of 10, I would say it's 6 or 7. So it's not a decisive buy, but if you have it, you should continue holding it. There are other large cap funds which to my mind from a future perspective can do better. So if you have it, enjoy the discount, but don't buy further, because on all the 6 parameters, I mentioned only 3. If you put them all, I would say 6 on 10 for this fund. So I can't say a strong buy, but not a sell for sure. So it's a hold.
Okay, so well, that's a hold on an equity fund. Now we're down to the last 2 funds. Remember, this is a list where we are telling you about the top 10 funds that are going to see the biggest fall in cost thanks to SEBI's new norms. And number 9 actually is a fund from the Aditya Birla Sun Life stable.
Correct. Aditya Birla's Sun Life Frontline Equity Fund, I think, is a sell, because if you have to stay in Aditya Birla itself, you can definitely look at an Aditya Birla Equity Fund, which is a multi-cap fund. But I'm sure you can live without an Aditya Birla Frontline Fund. Of course, I'm giving a sell.
Why do you say that?
Because what happens is, if you look at the risk to reward of this fund, okay, not to get technical, that's called the Sharpe ratio, is not very good. How much risk did you take to generate the return you have ended up generating?
Okay.
On that parameter, which is the most important parameter of investing, it doesn't fare that well.
Okay, all right, fair enough. And then we come down to the last, which also happens to be another large cap fund, the SBI Blue Chip. What is the fall-in cost here, and what's your view?
So SBI Blue Chip, from a relative standpoint, in the SBI fraternity, there's a better fund, which is the SBI MULTICAP fund, which operates with several analysts propelling the portfolio as against SBI Blue Chip. So SBI Blue Chip would be a sell and switch over to an SBI multi-cap fund. The fund house is great. Navneet Monod has done a wonderful job, but if you have another fund where 10 analysts, 5 analysts are working for you, that's a better fund. To summarize, see, what we see is there are about 3 to 4 funds which are in the hybrid category, and that's a clear sell. Then when we summarize that, large funds are largely not a buy. So out of the 10 funds, only 2
That's
I would...
a philosophy sort of theme for you, that you'd rather advise investing in a multi-cap fund rather than a large cap fund. That's why most of them are either holds or sells.
Correct. And what happens is, now in these 10 funds, we have close to 30% of the industry AUM. So this is not small AUM. We have covered 2.5 lakh crores out of the 9 lakh crores in a matter of 8-10 minutes.
Well, not too many of these funds impress Feroze, barring the KOTAK Select Multi-Cap. We're going to take a break. That was very interesting analysis. But the conversation continues. Is there something else you can look at where cost is falling, where perhaps, the cost factor becomes an incremental reason to consider an investment? That, and a quick example to help us understand how the lower cost really works out. Back after the break. Welcome back. You're watching Money, 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 and this week we have been talking to you about some of the funds that are going to see the biggest fall in the cost of investing this year. That is thanks to SEBI's new norms. Well, we did recap what you said, about 2 lakh crores of AUM out of the total 9 lakh crores. But Feroze is not too keen on any of these funds. Anything else apart from this big list that stood out for you, where there is a reduction in cost and maybe one should consider that fund? Anything else beyond these top 10?
Definitely. I think, see, you're going into active management. As a matter of principle, if you wrote down this principle, active management means agility. If the fund is so large, it will be detrimental to the active management itself. It's counterintuitive. You will not be able to move 30,000 crores actively because it's a lumpy chunk of money. So if you took smaller funds have also seen a reduction, but not to this extent. But once they grow, the reduction will automatically show up, because 2 funds of the same size will charge you the same cost. So over a period, you will anyways get to lower cost. So you can definitely look at an Invesco growth fund. It is definitely not a very large fund, a very small fund, less than 1,000 crores. But on the mid-cap segment, I would say that's my best bet. So
was the Invesco growth charging less? Will it charge us more now that the headroom sort of exists? It's in the 1,000 crores AUM category. So I'm guessing it can charge what, up to 2%? Up to 2%. So in the parlance of making a comparison between these large funds, you will end up paying 0.15% to 0.18% more. But I think it's worth, because that will bring in a lot of agility. It's very easy for a fund manager to move 100 crores out of the 800, which is close to 14% of his portfolio. But it's very difficult for a 30,000 crore fund to move 6,000 crores, 7,000 crores. So agility is what is active management. A smaller fund brings you the benefit at an incremental cost of 0.18% than these large funds. Okay, fair enough. There's also an example, Feroze, that your team has drawn up, taking, I think, the KOTAK Standard Multi-Cap, which is the one that you actually like. So how do the numbers now add up before and after? Let's take an example of a person who has 1 lakh rupee invested. The previous last year's cost was 21,200 rupees to manage. This is the cost? This is the cost of a 10 lakh rupee investment. A 10 lakh rupee investment in this fund. In KOTAK Standard Multi-Cap, you were being charged 21,200. You are expected to charge from this year on 18,508. So that's a saving of 2,700 rupees, close to 2,700 rupees per annum. Okay, all right.
on this fund on a 10 lakh rupee investment.
Okay, fair enough. So that's just a basic, understanding of how costs are going to go down. It's not very dramatic, but perhaps something to keep in mind. Feroze, as we wrap up, any other advice, anything else that you'd like to leave viewers with? Because over the last several months, we've seen dramatic changes in the mutual fund investment landscape, distribution, expense ratios. So much has changed. So FY20, any other advice?
So I think it's very important for the investor to understand the chronological order of importance of parameters. First parameter is return, second parameter is risk, third parameter is tax efficiency, fourth parameter is cost. People sometimes put the primary parameter as tax saving, the second parameter as cost, and risk reward takes a back seat. So if you arrange the parameters in this chronological order of importance, you will make right decisions and get into funds not just on the cost basis but on the value they create for you rather than just the cost.
Okay, I think that's a great thought to wrap up on. Thank you very much for enlightening us with those views and also telling us about the funds and how the expense ratios are changing. With that, we need to wrap up this edition of Money, Money, Money. Your feedback, comments and queries are welcome. As always, we'll see you again next week.